Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And this video was inspired by an episode of The Simpsons where basically the principal Skinner is trying to raise money for the school to go to New York. And so they're trying to recycle and they give him they go to a recycling center and they give this hippie like a ton of newspapers and he only gives them 75 cents back. And he's pissed off and he's like, dude, you gotta simplify, man. And I just, it's this facial expression is so funny the way he says it. But how's this related to velocity banking? Well, in my opinion, I think velocity banking, the beauty of it, that's a very simple strategy. And sometimes what happens with personal finance, and this is why, like, I don't use personal finance apps. Everything just gets so complicated, especially with budgeting, right? And what we're trying to do is find an easy, simple way to pay off debt. And what we're going to do is use our line of credit as our main operating account and dump our money into that line of credit. Very easy, right? So again, we're just going to do an average scenario, or what I think is an average scenario. And all we have to do for velocity banking is two requirements. Number one is a budget. So what's really important when we do the budget is that when we have our expense breakdown, we list every single debt that we have, right? Every single debt. If you don't have any debt, then you don't need to do the strategy. And we also need a line of credit as our main operating account, right? And the whole point of the line of credit is so that we can consolidate some debts and increase our cash flow. And so, some of you might be discovering the strategy for the first time and thinking, I don't have extra line of credit laying around. And that's unfortunate because you didn't learn the secret of getting credit, which is banks don't lend money to people who need it, right? Very unintuitive for the average American because they think of banks like they think of a restaurant. Oh, I go to a restaurant because I'm hungry. Therefore, when it comes to banks, I should go to a bank when I need money. And if you ever go to a bank and tell them that you need money, they're going to laugh you out the door, right? They're going to laugh you out the door, which is why it's important to get lines of credit before you ever need it. And this is why I have $268,000 in lines of credit ready for me to use. But back to my point. So again, very simple: income, expenses, whatever's left over, and we're in a pretty good position here, 1,600 a month, and we have a couple of credit cards. Again, we have to list every single debt, but because the whole point of this is that we pay off debt, and the more debt that we pay off, the more cash flow we get, and then that's going to allow us to make it easy and simple. Again, simplify, man. Look how pissed off he is. I love this facial expression. This has got to be my new image profile, right? Simplify, man. But again, simplify how you do your finances so that you can increase your cash flow and then quickly pay off, quickly pay off your debt. So we make two assumptions, right? So first one is that we have the same amount of income, and if you ever done any of sort of those after-tax calculations, this is exactly $100,000 in most states, right? You make $100,000 in most states, that's almost exactly 6,000 a month, and then we have what I would assume is the appropriate amount of debt. Again, three credit cards, an auto loan, a personal mortgage. Although this interest rate is kind of low nowadays, but they're still buying real estate, right, at the retail level. So now what we're gonna do again with velocity banking, it's mostly going to be the same. The left side is average American, right side is velocity banking. Now the left side here, what's the difference between the average American and someone just velocity banking? What is your main operating account, right? What is your main operating account? On the left side, it's your checking account, right? You pay things out of your checking account. In the right side here, it's your line of credit, and we're going to demonstrate how that works. So the most important thing we have to consider is that we're not going to have any savings. So you know how Dave Ramsey's like, hey, step one, to pay off debt, if in order to have a newbie emergency fund, he calls you a noob. If you ever look at like one of the step one diagrams, newbie emergency fund is to save $1,000, and we're gonna go the opposite of that, which is no savings, no savings, because I'm gonna put my entire money into a line of credit. And so now what we're gonna do, okay, is whoopsie, this is wrong. was instead of savings, we're going to have cash flow, which is very similar in the very beginning. Now, what we're going to do is have a line of credit as our main operating account, and because we're a homeowner, we probably have access to a line of credit, or we could get access to a line of credit called home equity, right? Home equity line of credit. I remember when I first bought a home, after like 2 months, I got a $15,000 home equity line of credit, and then a year later, I got a 50,000, 50, right? And then I might not even need a home equity line of credit. Um, like another one, or maybe I'll get another one because I'm going to have a home paid off soon, right? So, it's like a big A credit card. I don't want to say any cuss words here, but a big credit card, kind of like a big credit card based on the value of your home. But let's just assume that we have $50,000 in home equity, a home equity line of credit. It's kind of like a $50,000 credit card, but even better than a credit card in many ways because you can use it to pay anything. You can pay any loans, credit cards, debts. You can even use it to pay its own minimum payment. So if you had a zero balance and then you say, okay, I'm borrow $100 here, and then the actual monthly payment is like $10, just borrow another $10, and then you could satisfy the minimum monthly payment. Very powerful, right? Okay, so now what we're gonna do is just consolidate some debts and move it to home equity line of credit. Now, what's one way we could figure out which debts to move? I like to use the cash flow index because it's a very simple way. Again, we're going to simplify, right? It's a very simple way to figure out which debts go into the line of credit. And if you've never heard of the cash flow index system, just type in cash flow index on Google. And again, it's a system created by Garrett Gunderson. You have the loan balance divided by the monthly payment, and anything over 100 means that you don't pay it off. Over under 50 means you should pay it off. Excuse me. The way that I see of it is like a ranking system. So whatever is the lowest, you want to pay off first, and then you do even want to pay off the high number loans because usually if a loan is efficient, that means that you're paying a lot of interest if you just keep making that monthly payment. But the theory is that you should invest that money in somewhere else. Now, I don't know about you, if you think the average person is highly sophisticated in investing in the market, but when it comes to real estate, most people are quite terrible at it, to be honest. And you see them make some really questionable decisions. But let's go ahead and let's do this. Let's figure out the cash flow index of all of these debts. Right? Again, it's statement balance divided by monthly payment. And we'll just do this here. So 8,000 divided by 260. And then this one here is 15,000 divided by 487.5. And then auto loan is 23,000 divided by 447.87. And then this one is 225,000 divided by 948.61. So as you can see here, and actually let me reformat these so that there's only number 2 decimal places, which is what I want to see. Okay, so take a look here. So what does these numbers mean? So why should we pay this off first? So reason number one is obviously the high interest rates, right? And the high interest rates are kind of correlated with the low cash flow index number. But think about it like this, okay? Would you pay $225,000 just to get $948 back, or pay off $5,000 to get $175 back, right? Even, or let's just compare the auto loan and the personal mortgage, right? Would you pay $23,000, which is almost half of this payment, to get $447 back, or would you pay $225,000 to get $948 back, right? If I'm selecting between these two, I'd rather pay off the auto loan first because I'm going to get a lot more cash flow back. So you get a lot more bang for your buck. That's essentially the meaning of this cash flow index. So what I'm going to do here is I'm going to move these debts, especially the ones under 40 or 30, the really low ranking ones, to that line of credit. And we could do that. So if we add up the balances of the credit cards, that should be 28,000. So 5, 8, 13. 13 plus 15 is 28,000. So let's go ahead and move all of these to that line of credit, 28,000. Okay. And then, so now what happens just by simply moving these 3 credit cards to the home equity line of credit, 000, and then so now we went from 1,600 of savings, which is really good because the average American does not save. I've been reading studies for more than 10 years about how the average American can't save more than $400. Like they had a $400 emergency, life is over, right? So this is really good, but we're making even better, right? This is good, better. And so now the balance is going to go down uh, about $2,600 every single month, right? And again, what we're going to do, the actual strategy of velocity banking itself, it's almost like you don't have to think, right? You put your entire 6,000 here, and then you pull out the 3,000 of expenses, and then watch it go down $2,000, $2,600, right? And let's go ahead and calculate the next month's balance, which is the previous month's balance plus the previous month's interest minus our cash flow number. So 2603.52, right? And then now, because after every month we have to calculate the interest to the line of credit, we get it by the average daily balance. We multiply it by the interest rate, which is 10%, this 10 right here, divided by 12. And then, okay, we just copy and paste, right? Copy and paste. And as you can see here, in about a year, we just pay off 28 grand of debt. Didn't have to think about it, right? 28 grand of debt. Okay, so now what's this milestone right here? We'll say 12 months for 28K. Now, here's the crazy thing. I have seen YouTube videos where it's like, I paid off $10,000 in a year, and that those videos get like 100,000 views because most people they don't know how to do that. And so sometimes you make videos about, oh my goodness, like you can pay off $28,000 in 12 months. People freak out because they think you're a liar. Because sometimes, I learned this from a class a long time ago where sometimes like you should offer people lower returns because if what you tell them is a lot greater than what they're used to, they'll call you a liar. So like with most banks, they offer like a 1 to 4% interest, or even less than 1%, if you're especially working with a big bank. But if you tell them, oh, you get 12% return on real estate, they'll call you a liar, right? So something to consider. Okay, so now we got to deal with the auto loan, okay, because this is the next number in that cash flow index. Because we want to avoid, again, think of it as a ranking system, so 5135. And so now what we have to figure out after 12 months, what's the balance of the auto loan, right? And the way that we figure that out is just go to calculator.net, loan amortization, and then I go in here, and then let's figure out the balance of this loan. So 23,000, 5 years, not 58 years. And what's the interest rate? 6.3%, 6.3%. And I think I got this number by doing a Google search on what's like the current average car loan interest rates. And I think it was like 6.29 or something like that. So just copying it from, I forgot what website it was. Was it Toyota? I can't remember. All right. So now after 1 year, the ending balance is 18.9, right? So, or maybe we could use this number. Yeah, let's go ahead and use this number right here. All right, so now what's the balance of the loan now? It's 18,610.87. And again, the difference between the cash flow index for a credit card and a loan is that the cash flow index for a credit card usually stays the same because your payment is proportional to your debt, right? Whereas with the loan, because the payment is usually fixed, the cash flow index will go down. So 18,610.87, so 41.55. Again, not that great. If it was in our 30s, I'd definitely want to move it to the line of credit. But I have a feeling that if I move this entire thing into that line of credit, I'm going to put some money on the table, but it's not going to be that much, right? But let's just go ahead and move this thing to into a line of credit. So what we're going to do is move this 18,610.87 into here, right? And then what happens? Oh my goodness, this goes to zero. And now we're at $3,000 of cash flow. Oh my goodness. Look how simple that is. And this is my facial expression. Simplify, man. I'm just kidding. All right, so now let's go ahead and now what we got to do is just modify this cash flow to be this 3051.39, right? And then let's see how long it takes us to pay off that car loan. And it's going to be 18 months, right? So 18 months for, so 18 months. So what's 28 plus 23? So that'll be 50 something. 50 what? 51K, I think. I gotta do math. All right. So 23 plus 28 is, yeah, let me just do 23 plus 28 plus 28 is 51. Okay, so now at this point, we got to figure, hey, do we want to invest in real estate or do we want to just pay off our own personal mortgage? And we have a ton of cash flow, right? So if we have a tenant that doesn't pay, we'll probably be okay, right? And the most important thing, one of the most important things when it comes to real estate is that we have to do our numbers and we have to figure out, if we're going to invest, is it going to be a cash flow play or an equity play or even both, right? So sometimes you might have to delay getting some cash flow and while you get immediate equity on day one. And I talked to a guy who does a lot of multifamily, and usually when he buys a property, he tells me he doesn't cash flow for 3 years. For 3 years, he doesn't cash flow, right? So something to consider when we're buying rental real estate. And there's some properties out there that are good deals and you'll never cash flow, right? Because you build up so much equity because you're in a market like California where you bought it at the right time and you never cash flowed, but you built, that one house that you bought, it got you is essentially $1 million of equity, right? All right. So now, so personal mortgage 225, but let's just say, hey, we're gonna focus on paying off this $225,000 of mortgage. Now, you have two things you can do. You can put your cash directly into the mortgage, right? But realistically, who's going to do that? Most people will never do that because statistically, your average American doesn't pay off their mortgage in 30 years because they get a letter from the bank. Oh my goodness, you could refinance and get a lower monthly payment because they don't have simple strategies like this. You ever look at most budgeting apps and see how complicated they are? And then, kind of like a diet, they just kind of give up after like 1 month. They get really excited, they give up after 1 month, and then they're like, oh, screw this. And so their money and budget is all over the place, right? And I know this because a lot of you just email me out of the blue, please solve my problems, even though I don't that's not what I intend to do with this channel. But a lot of you, even if you're rich, right, like super making good money, are just randomly emailing your spreadsheets about how you're broke and you're making a lot of money. And again, usually most people never even get to this point of they have that their mortgage is their only debt. And if they do, they either overpaid for the real estate, which is really common. And I was talking about buy it at a discount, right? Or, you know, uh, even if they could overpay their extra payments to the loan, they'll usually never do it because they're afraid. Like they're afraid of putting their entire cash into the loan because what if something happens? You put, let's say, this entire $3,000 into the loan. Are most people going to really do that? Probably not. So one of the things that we can do is that yes, we can overpay, but if we do with the line of credit, it's almost the exact same thing, right? Because your cash flow is so much that your interest rate, honestly, it does matter, but it doesn't. Okay, so I'll show you an example what I mean by that. Well, let's say we moved $6,000, so this is going to be 229 or not 229, 219. Okay, so let's say we move $6,000 into the line of credit, and actually let's do this. So let me put this number right here. So 225,000 000 at 30 years, and we have a very low interest rate mortgage. Okay, so how long if we take a look at this, is it going to take for us to go to 225 to about 219? 225 to about 219. Interesting. 225. So a little bit more than a year, right? So about 1 year it's going to take us to get to 225 to 119. Okay? So what if we just do this, right? So we move 6K into our line of credit. Okay? We have one place to put our money, making it really easy to overpay, yet we still have control. Okay? So plus 6000. And let's see how long it takes for us to pay off that 6,000. 2 months. So something that was going to take us 1 year took us 2 months. Okay? And look how little interest we paid. Okay, $50. Whoop-de-doo, right? And it's probably less, like, it's probably going to be a little bit quicker than this because, well, actually, let me rephrase what I'm saying. So one of the things that when it comes to like the total payoff time that we have to consider is that we're still making that monthly payment while transferring some of this mortgage to line of credit, right? They have names for it. They call it incremental payoff chunking. But one of the reasons why this might be easier is because you don't have to think about what it is that you're doing. And sometimes that itself is very valuable. Most people don't understand this, right? People who are very intellectual, I mean, this is the same reason why Dave Ramsey tells you do the snowball method, because if you do the avalanche method, you're never going to get it done, right? Just like extra payments is essentially the avalanche method. Another way you could think about it is like a UPS left turn. Do you know that UPS tells their drivers never make a left turn? Because even though it's, quote, more efficient to make the left turn, it's actually more inefficient. I don't know if you've ever seen that, but just type in UPS left turn, right? Why UPS trucks almost never turn left, and this is from 2017, because they know that if you make a left turn, it's actually going to be harder for you to make your delivery than if you're just always making a right? Hopefully that makes sense. All right, so now let's figure out what the balance is of this loan after 18 months. So let's take a look at this. So 18 months, about 3 years. No. See how fast I am? Some of you are like, you're so fast. And it's like, you got to practice more, right? If you're trying to learn piano, don't tell Beethoven to slow down. You know what I'm saying? All right. So now, currently at 18 months, it's 217,000, right? And so we could just kind of do what I talked about. We have a velocity banking calculator for this from Renatus. This is where I first learned velocity banking from. And all it is a plug and play calculator that will tell you the payoff date if you just do what it is that I'm saying. So let me just kind of put this here. So 225,000. Again, this is where I first learned velocity banking from in 2017. And I had no idea what was going on. I was like, what's a line of credit? And, what's funny is I'll probably be the only person that I know who's going to pay off their 30-year mortgage in about 3 years. Kind of crazy, right? I wish I could do like 1 or 2, but I'm not that good. All right, so now, so let's go ahead and put in these numbers right here. So interest rate is 3%, 30 years, and this is the payment's going to be 948.61. All right, and then the chunk amount. So this is very interesting, right? So one of the things that we can learn from here is not to replace your entire mortgage into a line of credit. Okay, like I'm going to show you a couple of numbers, and people get really surprised by this, and they try to argue with me, because again, the internet says very simplistic things about put your entire mortgage into that line of credit, and I've never seen any evidence that you should do so, because, and I'll show you what I mean by that. So let's go ahead and put in our numbers here. So our income is $6,000, and our expenses is 2,000, right? It's everything except for the loan we're trying to pay off. So we put 2,000 right here. Now let's just move 6,000, right? 6,000, and let's just kind of remember a few numbers. So this is going to take us 5 years to pay off, and the interest that we pay is not that much, like 18 grand, right? Now, Okay, so let's take a look here. So what if I move this entire thing into the line of credit? So instead of 6,000, let's say we had a 200, we had this really huge line of credit. So 217,496.5. Compare this. So usually in my experience, this usually doubles, and then this is almost the same, but it takes a little bit longer. It might be a year or two, but it depends on the cash flow. Ooh, let's go back here. So basically, if we put this whole thing into a 10% line of credit, 217,496.5, whoopsie, 217,496.5, this is essentially going to go jump up 7 times, right? So it's going to be $70,000, and it takes us 1.2 years longer, right? So this is why, when you when you're again, I always tell you this almost every single video. Like, I don't see a reason to be able to pay off the entire thing with the mortgage and replace it. To me, that doesn't, the math ain't mathing out, but whatever. So let's just do this. Let's just play with a few numbers. So 6,000, and then probably if we just do 10,000, it's going to be very similar, but this is probably going to go up a little bit, right? Yeah, actually 10,000 is almost the same thing. Isn't that crazy how that works? Right? Now, here's a crazy thing. Here's another thing that I I was taught a long time ago, and I actually figured this out. If I do a 30%, let's say credit card, let's just do this, $6,000, and I instead of a 10% line of credit, I use a 30% credit card. I play with plastique. I get some of those bonus rewards points to kind of offset the cost, and I do 30% here. Okay, it only goes up by 5 grand, right? And the payoff is almost very similar. So you could probably, use rewards points to kind of offset this 5 grand if you really wanted to. But I mean, you don't have to, but I'm just saying is that interest rate does matter, but it doesn't matter as much as people make a big deal, right? Like, what's even more important than the interest rate is the purchase price. People don't, like, in the United States, like, they love low interest rate mortgages, but they don't care about overpaying for property, which is why a lot of them go broke, right? And this is why, when you type in how many millennials regret buying a home, it's 90%, right? 90% of millennial homeowners regret buying their home. Sure, gee, more evidence that our generation was not set up to succeed. Whopping 90%. So, you know, there's a reason why people are looking for solutions. I didn't create the marketplace for this material. It's because the traditional way of whatever it is that we're doing doesn't work. Anyways, so let's just go back here. I'll do 10%, right? And we could just do $10,000. $10,000 chunks, almost the same thing. Um, I'd have to figure out how many times. And again, this is all of this is kind of like right here as to how long it takes for us to pay off that $10,000, line of credit. So let me just take a quick look. So $10,000 lock balance, 9,000, 6,000. I get 7,000, 4,000. Interesting. So about 6 months. I'm just kind of winging the math, but all right. Well, so it's 5 years. So let's just go ahead and put that right here. So what's 5? So 18 divided by 12. What's 18 divided by 12? So so it'll be 6.5 years. And then we're going to be 51 plus 225. So 51 plus 225. So that's 276K, right? So we're basically going to be debt free under 7 years, including our mortgage. So it's not just the mortgage that took under 7 years. It's the 3 credit cards, the auto loan, and the mortgage. And now we got this extreme. We got what we call rich people problems. And if you ever dealt with rich people and they got savings, you know what happens? They get a little bit nervous because, like, I'm losing money to inflation. I always want to invest it, right? That's what happens with rich people when they have checking savings. And in fact, I know one guy who offered me millions of dollars to invest in real estate, and I didn't have the heart to tell them that I'm pretty lazy and I don't want to look for deals. But I gotta start looking for some soon. And then here's the cool thing: I'm gonna have a huge line of credit available for me to use. So, sky's the limit. But what's more important when it comes to real estate investing is that you have an actual deal because, especially if you don't have money right now, this is very hard for you to believe. The deal is more important and hard to find than the money, right? Totally blew my mind when I first heard that. But yeah, so we're gonna have what's it called? Rich people problems now because all our debts are paid off under 7 years. All right, well that's it for today. Just another review of Velocity Banking. Where I first learned this from, Renatus, and kind of full disclosure, I make money off of selling Renatus products, so that's why I kind of promote it. I'm an independent contracting marketer, so what that means is that I get a commission for selling their products. So if you have never heard of Renatus, you might want to check them out. And yeah, simplify, man. All right. So, have anything else to add? Well, that's it for today. Have a great day, everybody, and we'll speak next time.